Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Barry Schwartz. He's Chief Investment Officer and Portfolio Manager at Baskin Wealth Management, to talk about somebody who you've been a big fan of over the years, Charlie Munger, the partner of Warren Buffett, a legendary value investor. And of course, he sadly passed away. Happily, he lived a good long life.
That's right.
Almost 100 years old.
That's right. His birthday would have been on January 1st. So 100, almost 100 years, and 99 years of compounding his learning and investing, and working alongside with Warren Buffett. But many don't know that Charlie Munger was one of the world's greatest thinkers, not only on investing, but on life, on psychology. There's a new version of his book called Poor Charlie's Almanac coming out on Tuesday. I highly recommend people get that. It's a collection of essays and speeches that he's given over the years. But Paul, one of the speeches that really inspired me as an investor is the one he gave called The Art of Stock Picking. And in that speech, he really laid out the playbook of how to invest in high-quality companies, something that he pushed Warren Buffett to do early on, when Buffett was buying what we call cigar butts. Cigar butts they would be maybe one puff left in them, and then that would be it. And then
And does that include the textile mill that began it all? Berkshire Hathaway was a textile mill at the point that Buffett bought it.
That's right. Buffett used to follow the Benjamin Graham style of investing, which was looking for companies that are very, very cheap, have lots of cash on their balance sheets, but probably terrible businesses. And the problem being a long-term investor with that strategy is you have to constantly find new ones, and it's not easy. And probably they're cheap for a very good reason, because they're terrible, horrible companies. Munger in this speech really told investors, you need to start looking for companies that have specific advantages, ways that they can grow their businesses, whether they have wonderful management, whether they are so big that they can benefit from economies of scale, from advertising. And so those types of companies that Buffett started to buy, in his career after buying lousy companies like Coca-Cola, Gillette, which doesn't really exist anymore. It's part of, I think, one of the larger entities. He started buying Moody's, he started buying Disney, just companies that could reinvest cash flow at higher rates, and he held them for a very long period of time. And so that's the playbook for high-quality investors.
What are some of the advantages of holding for a long period of time and not, succumbing to the temptation to take profits?
Yeah, so the problem with taking profits is it interrupts your compounding, and you also have to pay taxes early to the government. In Canada, with capital gains tax rate, you're giving almost 30% away to the government just because, oh yeah, I'm up a little bit. You always hear the story, pigs never benefit by not taking profits, right? You have to if you take profits, it's a big problem when the company keeps compounding, and if it keeps growing and reinvesting its equity at double digits each and every year, you're going to miss out. Stock prices fluctuate all the time, but you don't have to be forced to sell them. So that's what Charlie Munger learned, is I'm going to hold stocks for a very long time. He passed away a billionaire, owning lots of shares, of course, of Berkshire Hathaway, which he never sold unless he donated to charity, as well as he's one of the largest single owners of Costco shares, over $100 million of Costco, just holding on, never selling. And that's how you invest. Concentrate on your best ideas, and don't give away money to the government early.
Have you at Baskin owned shares of companies like Coca-Cola, Costco, some of the big holds of Berkshire Hathaway?
Whenever Buffett buys a stock, we're always very interested. We've owned, Berkshire has made a gigantic bet on Apple. It's over 50% of its stock holdings. We've owned Apple for a very long period of time. We own companies like Moody's. We own companies like, the companies at Visa, which Berkshire also owns. Coca-Cola is a great company. Never really bit the bullet on it, but one that we could at some point in time. So absolutely, whatever Buffett buys, we take a look and do a deep, hard research on it.
That's Barry Schwartz. He is our featured guest of the morning, a big fan of Charlie Munger and, of course, Warren Buffett as well.
The UN's COP28 climate conference continues in Dubai, and one of the topics is the state of the world's oceans. Of course, the ocean is a huge mechanism for capturing CO2. Here's how important it is to Canada's economy, almost $10 billion it's worth. And there has been a massive increase in sustainable seafood sales over the past 5 years or so. And almost 2/3 of the seafood sold by Canada does count or qualifies as sustainable. Let's get more from Curtis Hain, Program Director at MSC Canada. First off, put fishing and seafood in the oceans into context with climate change.
Sure. If the planet had stakeholders, the oceans would be majority stakeholders. Over 70% of the globe's our ocean. It's absorbing a lot of the CO2 emissions, carbon emissions, and it's just really important in the climate conversation. A healthy planet or healthy oceans are going to mean a healthy planet, and we really have to make sure that we're taking care of our oceans, and that includes things like sustainable fishing. Overfishing and bycatch are still two of the largest problems facing our ocean, causing biodiversity losses. And without a healthy ocean, we can't really have a healthy climate. So they're all interlinked and incredibly important together.
We do hear a lot that livestock production is a big contributor to methane and carbon emissions generally. If we ate more seafood as protein, would that help to curb that?
It would. Again, wild seafood, sustainably harvested, is a low carbon footprint protein. And there's billions of people that rely on it globally around the world. You mentioned the importance to Canadian markets, but it's globally traded at about $151 billion a year. Seafood is. So it's incredibly important that it contributes to our global economy. But it's a low carbon footprint protein. So more seafood consumption is probably a good thing as long as it's done sustainably, because that's really important, making sure that we'll have seafood safeguarded for future generations as well. Those industries, those coastal communities will be sustainable.
Although I have heard, though, that wild-caught shrimp and lobster can be very high in their carbon, partly because of the fuel needed for the boats.
It depends on this type of seafood, depending on the carbon inputs. But generally speaking, seafood tends to be much lower carbon footprint, and it also doesn't rely on water input. So it's our last real natural wild resource and renewable resource in terms of food from a wild resource. So it can be very low carbon.
Now, you guys at MSC Marine Sustainability Canada, you're involved in certifying seafood. Are you the only group that does that, or are there others in Canada?
So currently, we're the world's leading certification for sustainable seafood. As you mentioned, about 61.5% of all fisheries in Canada are certified against the MSC program. And you talked about the report we just released. It's called the State of the Water Report. We wanted to look back 15 years and really look at some of the improvements fisheries have made. And across the board, they've shown improvements while they've been engaged and certified against their program. They've increased their sustainability scores across our entire standard. So generally, in terms of wild-caught seafood, we're the sustainable seafood organization most people look to, and markets are looking to. We have our Bluefish Eco-Label, so we're also a markets-facing program. Retailers can demonstrate their sustainability, and consumers can look for us out in the grocery store to make sure that they're buying a sustainable choice.
One thing I'm curious about, you probably have seen the horrifying stories over the past few months about the treatment of people on some of these Chinese factory ships, and we know that the Thai fishing industry hasn't got a great record either. Do you take that into account, the actual treatment of workers?
So we, human rights in seafood supply chains and in fisheries is a big concern of our program. We have mechanisms in place to ensure that human rights abuses don't exist in our supply chains. There needs to be a lot more global focus on this. It's a really hard problem to eradicate in fishing, but also in seafood supply chains, global food supply chains and global supply chains in general, even outside of seafood. So it will take a global effort to combat that. But we've got some mechanisms through our certification program to ensure that that doesn't enter MSC supply chains.
Curtis, thank you very much. It's always great hearing from you.
Thank you so much.
Curtis Hain, Program Director at MSC Canada.
Welcome back to Bloomberg Markets. I'm John Oakman. Looks like Amazon is gearing up for quite a battle with the Chinese fast fashion upstart Shen. Amazon plans to sharply cut so-called seller fees in January. Shein is known for its ultra-cheap clothing. The e-commerce giant will cut fees for merchants selling clothing priced below $20. The reduction, rare for Amazon, and will make it more competitive in the low-price apparel category. Poonam Goyal is a senior analyst covering the U.S. retail sector for Bloomberg Intelligence and joins us with more. So, Poonam, nice to see you. We characterize this as a rare move for Amazon. What's behind this from your perspective?
I think it's a market share game. So what you're seeing is Amazon is addressing a threat that's coming up about it on the apparel space. Our calculation is that Amazon controls about 16% of the GMV that it has in apparel, and that's about $70+ billion in sales in the US. Now, when you look at the size of that, there's clearly an opportunity to get bigger, but there are also other entrants that are coming up very close into the space, and Shein is one of them. You know, Shein's growth has been remarkable in the last few years. They're estimated to have grown from 15 billion to 22 billion last year, which, as you can see with the rate, that there's clearly a threat to not just Amazon, but to other apparel retailers as well. And this move just, is a move so Amazon can get sellers onto its platform by giving them an opportunity to make more profits.
And I guess we might hear more in the public market about Shein, given there's all this focus now on the possible IPO. How do you see this battle, more broadly speaking, playing out between these two? Are we going to be sort of talking about these mega retail forces battling it out for years to come?
I think, they definitely will be battling it out, but keep in mind that Shein's price points and where Amazon is offering this discounted seller fee is at under $20, right? So it's really, truly fast fashion. And there's a lot more apparel being sold than just at those under the $20 price point. But I think as they drop the fees and they use their distribution network, which is one of the best that exists in the US, they can bring in more sellers and drive even greater scale in that lower price point market. So I think this move is really to get that scale at even lower price point.
All right, Poonam, thanks very much. Poonam Goyal on the Amazon Shein story.
Well, let's dig into the latest results from Lululemon. They are out, and as you can see, Lululemon is under pressure in after-hours trading. The share's down 6%, and it looks like it comes down to the fourth quarter revenue outlook. So the results were for the third quarter, but looking ahead, Lululemon sees a revenue that is below where the estimates were. So $3.14 billion to $3.17 billion. The estimate had been $3.18 billion for the fourth quarter revenue. But if we look at the third quarter results, the adjusted earnings per share was a beat, 253 instead of 229 was the estimate. Third quarter revenue was a hair above $2.2 billion versus $2.19 billion. Third quarter gross margin was slightly below, but 57% versus 57.7%. And comparable store sales, we're looking at an increase of 9%, and the expectation was just a bit below that, 8.6%. So interesting, the results for the third quarter seem to be in line, but looking ahead to that fourth quarter, that might be where the concern is coming from for investors. But let's get an analyst take on this. Jessica Ramirez, she's senior analyst at Jane Halley and Associates, joins us now. So Jessica, what do you make of the results coming across the wire here from Lulu?
Thank you for having me. Well, I think a lot of what we've seen with Lulu, as far as earnings, now that you're mentioning, guidance going forward being a little bit down or cautious, really, is really what we've seen from a lot of other brands and retailers, where we've seen some strong results in some cases and some mixed, but going forward, just because of the climate that we do have with the consumer and around the globe, it is taking a caution approach overall. So I feel like that makes sense. However, Lulu is a very strong brand overall, so we can still see that with the numbers, even despite the climate that we're going through. This brand continues to deliver strong results, and also, has the customer coming back into their doors and into their website.
So what do you make of the reaction that we're seeing, at least the sort of knee-jerk reaction in after-hours trading with the shares down 5%? Do you think that is warranted?
Yeah, so also I think we have to consider with Lululemon, they are at a very high price. I mean, this morning it opened at 460 and it went up to 466 during the day. So it is quite a strong stock overall. So anything that might give a bit of a concern, again, the conservatism around what Q4 might look like, especially in the climate that we're seeing today with holiday, expectations being quite low for a holiday season. I think that makes sense to see this sort of reaction.
Right, of course, because the holidays are so important to retailers. And I guess when you mention where the stock has been trading, Jessica, that's part of part of what plays into your view on the stock, because you have a neutral rating, right?
Yeah, so for the quarter, we were quite neutral. I mean, we do feel they were up against very tough comparisons year over year, which made us a bit cautious overall. Again, we believe in the brand. We like their retail playbook. We like the product that they have. We like their angle. And there's a lot of room for growth. But I think, really putting into consideration where Lulu stands at today, that's really why we were neutral for the quarter.
Now, Lululemon recently struck this deal with Peloton. What do you make of that partnership?
Yeah, so we find that to be quite interesting. So when I speak to growth, there's been growth internationally that we're very interested on, and we feel they have quite a good way into that. So looking at EMEA, for example, and also APAC in particular, China. So with the Peloton partnership, with that, what we do feel is they can acquire customers and also on an international level. So they do have other parts, especially particularly in EMEA, where they can extend to. So that makes sense. So we quite like that. And it makes it a little bit easier for them for the studio part to be run from Peloton. I do think Peloton overall does have a very strong presence in that, even though we've seen, the trouble with Peloton in itself, but the program that they run is very strong. And I think that makes sense. That has a synergy as far as a partnership overall.
And it's going to be stopping making the mirror, that fitness mirror. So kind of interesting to be having the partnership in the fitness world. But yeah, it's making some changes when it comes to what it does beyond clothing, Jessica.
So that makes sense. I think kind of two things to look at that. So the studio part, that takes something away from them so they can continue to focus on what they do. And again, that Peloton partnership really complementing that. And what we've really liked about Lulu is that they've become this lifestyle brand, and they've tapped into every single part of the consumer. And as the consumer has become more interested in wellness, and that wellness umbrella has really opened up, again, that makes the brand much more powerful and a go-to for the customers. So, you can get your products, so your leggings for workout, your sports bras, and you can also find a lot of versatile clothing that you can use for every day. There's footwear now, and the footwear is looking really good. You have very strong accessories, and that's been a strong category for them. And then you have the studio life, and you either have events in store, you have events around the globe, and being able to really capture this whole lifestyle that this customer has now really embraced. That makes it a very strong brand. And again, the customer will be loyal and will continue to come back to Lulu. And obviously we've seen that to be true over the past few years. So again, we quite like the lifestyle approach that the brand has really taken on.
At Lululemon, it's talked about its plans to expand within China. It already does sell in China, but plans to expand there. What sort of an opportunity do you see that as to help with, continuing the growth in sales here for Lululemon?
Yeah, so currently, there's room to grow in that area. And I think what they've done really well and we quite like is, and not only in China do they do this, but around the globe, is really localize the product. There is particular sizing that is suited for the customer there, particular events and bits like that. And again, it gives it a very strong name overall. So that we still really like in general.
Oh, that's interesting. So it's sort of personalized to the country that it's in?
Yeah, so there you could see some of the differences in sizing. And also just so when you have a brand that is so global, and you see this with Lulu, you see this with quite some other ones, you do localize the product that you might have. So the product that might be in China compared to the product that you might find in London to New York, that product will sit differently. You may have some overlap in some of the collections, maybe some of the strongest ones, but there will be localized product because, again, the customer that is in New York City isn't the customer that's in London or the customer that might be in China overall. So that is part of that strength, and really just focusing on being regional to a sense.
Jessica, great to get your insights into Lululemon, what it's up against these days, but also the latest results for the company as well. Interesting to watch the after-hours trade as well. Paring back that loss a little bit, it was just over 3% lower when we were last looking. Jessica, thanks so much for your time. Really appreciate it.
Thank you. Have a good one.
Thanks, you too. That was Jessica Ramirez, Senior Analyst at Jane Halley and Associates.
Airline stocks have struggled in the past couple of months as the so-called revenge travel boost starts to wane a little bit. And there's nervousness about what exactly will the demand picture look like in 2024. And will airlines be able to maintain their pricing power? Now, our next guest, he's got the benefit of being a private company, so doesn't have to answer to those quarterly disclosures, but also has been expanding its fleet and the number of destinations that it travels to. Join me now is Michael DeLuz, President and CEO of Porter Airlines. Michael, thank you so much for being with us.
Thanks, Amber, for having me.
So let's talk about what seems to be making people just generally nervous about the investing climate in airlines. Is what's that demand picture shaping up to be like? How's it looking for the holidays, and how do you think the setup is going to look for 2024?
And there certainly are some economic pressures coming from inflation across the Canadian economy, but in Porter's case, we're seeing very, very strong demand for bookings throughout next year as well. The holiday season is shaping up to be an extremely robust demand environment. So at this point, we're not seeing any signs of weakening of what has been a very strong demand environment for the last year.
Is it coming, do you feel like you have to entice the travelers a little bit more through increased promotions?
We have a significant growth plan underway right now. And so our situation may be different than other carriers. We are seeing revenue at 250% of last year's November and December levels. We're seeing forward bookings that are materially higher than last year. And so, overall, we have a lot of moving parts in our business, but the fare environment is holding up very well.
Let's talk about the expansion. I mentioned, you're going to be adding to your fleet in the next 2 years in a major way. You're adding to your destinations and your partnerships. Is that part of a kind of a strategic vision, or is there kind of a cyclical view that's also underpinning that?
Porter, back about 18 months ago, launched significant growth plans that were intended to take what was a regional network of flying refined experience, elevating economy for everyone, and rolling that underpinning across a North American expansion strategy. As part of that strategy, we did place an order for 50 firm plus 50 option, total of 100 E195, E2 aircraft. We recently converted 25 options into firm aircraft, so our total order book is 75 new state-of-the-art narrow-body aircraft, and we're deploying those aircraft out of Toronto Pearson, Ottawa, Montreal, and Halifax to a range of destinations, coast to coast, Canada, the US, Mexico, and the Caribbean. And to date, in 2023, we have taken a total of 25 brand new aircraft alone in the last 11 months.
And you haven't pared back any of those ambitions, even as it looks like Canada's growth is stalling and many economists are looking for a recession next year.
These are all new markets for us, and we're carving out significant market share as we enter new markets. And to date, we've been able to deploy 25 aircraft to a total of 29 new routes in the last 12 months, and very much focused on continuing that growth plan next year.
You mentioned kind of flying refined. It's hard to do that when there are delays. And we know that this year there have been delays in the travel industry for a number of reasons. Labor shortages is one of them. But what does that look like now? The headache that, travelers have to endure for something that should be a 2-3 hour trip that turns into a 12, 13 hour affair.
Yeah, I think everyone's seen the media reports with the two main carriers in Canada being amongst the worst on-time performance carriers across North America. We're not on that list. Porter has been operating at very significant reliability levels. And as a result of that, customer satisfaction, net promoter score have been through the roof as customers need a reliable solution for air travel. And so we're focused on every flight trying to deliver the best possible experience on time. The industry is not perfect. You have weather, you have maintenance events, but we are making a significant impact in delivering a reliable, elevated economy experience into the market.
How's the labor picture showing up? We hear a lot about labor shortages, whether it's on the attendant side or certainly on the pilot side. What are you seeing?
So the one that gets the most media attention be pilot shortages. That's more acute in the US, but in Canada, the market remains tight. We've hired 300 new pilots in the last 12 months. Every month, we're hiring 24 new pilots and putting them through extensive training programs. And Porter has not seen any shortage of candidates within the market. And I think part of that is because the exciting growth plans that we're putting into the market, and for pilots that want to continue to develop their career, Porter offers the fastest path to a left seat in a narrow body aircraft of any airline in Canada.
Well, you know I'm BNN, so I'm going to end with this question that I always ask. Plans to go public, you've got growth, you've got ambitious spending plans. Do you need the public markets to finance some of that?
So as of now, we're well capitalized. So in the near term, we have no plans for an IPO. And we'll continue to roll out the first 50 aircraft in our growth plan throughout 2024. It's something possible in the future, but we are well capitalized and have no requirements for public money, public market capital at this point.
And is that how you guys think about it? You know, I know this conversation comes up from time to time, but is it, you know, do we need to do this? Do we need the financing? What's the threshold of going public? What's the thing that always stops those conversations?
At the end of the day, it is a much more onerous situation, but it does come with benefits of having access to public market capital. But as I said, we have substantial capital on the balance sheet. We are, I think, the only airline in Canada with a positive shareholder equity position. And you know, we have no immediate incremental capital plans that would require public market capital. So at this point, there's no logical reason for us to pursue an IPO, but it is a very, very exciting growth plan. And at some point in the future, it could be a logical step.
All right. Well, you know, I'll pepper you with questions if that step were ever to present itself. Michael, thank you so much for joining us and giving us your insights about the travel season and your expansion plans. That's Michael Deluce joining us, President and CEO of Porter Airlines.